It's also Veterans Day.
Okay, here we go again. It must be Tuesday, 5 o'clock in California. Welcome to my channel. I'm going to wait a few minutes or a few seconds to have some people join in. We, as I say all the time, we have a very interesting topic today. But today's topic is very, very interesting, very new, and it's mind-blowing. And I'll give you, while we're waiting, let me turn on the Instagram that I'm supposed to click on Go Live. There you go. Okay, the reason today's topic is very exciting and mind-blowing is because the topic is Trump announces 50-year mortgage and what you must know. And of course, this is an idea floating out there. The head of housing, or what's his name? Let me see. I have his name. I'll tell you. I should have known it. But anyway, the guy who used to be with Pulte Homes, what's his name? He's working on creating a proposal, or what do you call it, to have a 50-year mortgage. So we have a lot to talk about. But before we get started, I wanted to ask you a question as we get started. And I'm going to introduce my guest today. He's very knowledgeable about the mortgages. He's very knowledgeable about what's happening on the market. He's been a guest here previously. So the question is, would you take a mortgage you will still be paying for when you're 80 or 90 years old? Let us know in the comments. Let us know what you think. In the meantime, I want to introduce Matthew Scher. He's from Atlanta. Matthew is an associate broker or a broker associate. Matthew, take a few minutes, introduce yourself, and then we'll jump right into it.
Sure. As you said, Matthew Scher. I'm in the Atlanta metro area. I am an associate broker, and I'm also a good resource here because I'm also a licensed mortgage loan originator. So I kind of do both, and I see it from the agent side and the lender side. So I might be able to add some input.
Right. And that's one of the reasons I invited Matthew to this, because this is more mortgage than real estate, but then it's both. So here's some of the topics we're going to talk about. Number one is, would you take a 50-year loan? Is it a good idea? Is it going to increase home prices or decrease home prices as we go along? And then what does it cost to get a 50-year loan? And my answer to that is, let me see. This is something new. I'm going to try it out. Let me see here.
If you're looking for what the difference is.
Yeah. Okay.
At the same interest rate, before this session, I went in ChatGPT and just asked it, $500,000 loan, for example, how much would the difference in payment be for a 50-year amortization versus a 30-year? And at the same interest rate, it was approximately $300 a month difference.
Right. Let me show you something. This is very, very interesting. And I want to show this, why I think it's a bad idea. I want to get right into it so I can make my point. Can you see the screen?
I can, yeah.
Okay,
yes.
So let's look at this. If you buy a house with a loan amount of $500,000, whether you're paying 100% loan, or let's say the loan amount is $500,000, if you get a 30-year loan at a 6.3% interest rate, guess how much you're paying? Of course, your payment is $30.94 per month. This is the principal and interest. Your total interest that you pay through the life of your loan, if you keep it for 30 years, is $600,000. And the total payment you pay for the house, principal and interest, is 1.114. But here's what I want to show you. And this is why I'm not a big fan of this loan. And I'm going to do a drum roll before I change it. This is something new that just came up, and I had to do it. So, yeah. So let me change it to 50 years. And I'm going to be nice here. Nice in the sense, no, I'm going to be actually, if you get a 50-year loan, they're not going to charge you 6.3%. They're going to charge you higher. So I'm going to go to 7%. Just like if you get a 30-year loan versus a 15-year loan, the 15-year is cheaper than 30-year. And the 30-year is going to be cheaper than 50. So I'm being very honest.
And it's probably going to be about 0.5% is what I
right. So let's go 6.8 to be nice. 6.8 from 6.3. Guess what happens? On a 30-year loan, again, your payment is $3,094. Your total payments, principal and interest, is $1.1 million. the total interest is 614. Guess what happens on a 50-year loan? This is what happens. Okay, your payment drops by about $100, but look at what I'm trying to get at. The total payments of your house of a 500,000 loan jumps to 3 times the value, 1.7 million, and your total interest is 1.2. So in other words, if you get a 500,000 loan, you're going to pay $1 million in just interest plus the house. What's your take on this, Matthew?
Yeah, so my take is for most cases, it's not worth it. And something else I'd like to point out, if you were to look at, and you don't have to pull it up, but if you were to look at a amortization schedule of this loan, you would see that a lot of people don't realize that, they think that the loan is, they use the term that loans are front loaded, where you pay more interest in the beginning of the loan. And that's true, but it's not necessarily a by design thing, where they're not charging you more interest in the beginning. The reason why it takes a while to chip away at the principal is because as you do chip away at the principal, the balance goes down a little bit, and then you're paying interest on that lower balance. Just like it's the reverse of compounding interest, when you're paying it. So by the time you get, 15 years into a 30-year loan, you've made enough principal contributions that your monthly payment, the payment remains the same, but a higher portion of it can go towards principal as you go.
Right.
With these 50-year loans, it's going to take a lot longer. Like right now with a 30-year loan, I think it's around 10 years in that you really start to see some equity gain. With a 50-year loan, I'm imagining it'd be 25 years before you, probably about 20 years.
Right.
And the problem is the average time people live in their house is maybe 7 years or so. So I think down the road, what will happen is there's going to be a lot of rude awakening when people buy with these 50-year mortgages. Then they go to sell and they find that after paying the mortgage for 7 years, they owe the same amount that they started with, and they don't even have enough equity to pay the realtor commissions or. So that's a big problem.
Yeah. We got a comment from, it's Mrs. Simmons. Thanks, Simmons. She says that it will take longer to see any equity, if any. You're absolutely right. In fact, I was doing some math on the computer, and what they said that on a 500,000 loan at around 6%, up to the first 10 years, you know how much equity you will gain in the first 10 years? About 30,000. Then they said, what if, and my prediction is, of course, not my prediction, but the prediction is, or the forecast is from the HSES or all these 100 gurus and analytics companies, they're saying for the 26, 27, 28, 29, home prices are going to go up. So let's assume it goes up. You bought a house right now for $500,000 loan amount. Let's say after 6-7 years, and which is my theory, that the prices will go down after 28, 29, 30. And this time it will be a long, long downturn, just like it has been a long, long, long upturn. So what they're saying, if the market goes down 5% on a $500,000 house, you lose $25,000. So if in 10 years you only gain 30,000 in equity, and if you want to sell, you can't sell because you don't have any equity. Your loan amount is still 470, your house value is 470, and it's going to be hard for you to sell. I mean, that's what they're saying.
Right.
So look at this scenario here. I mean, I just can't believe this to be so true. On a loan of 50 years, you paying the house at 1.75, and maybe you know more, Matthew. What is the average in general, average times a homeowner refinances?
Well, that's going to vary depending on what rates do in the market. Generally, people refinance when the market rate is a full percentage point below what they are currently at.
Okay.
So a couple of years ago, when the rates were falling, or 5 years ago, there was a lot of people refinancing every 6 months.
Yep.
Because the rates were just dropping. But now no one's refinancing. And
Yep. I have a friend in my neighborhood. There's a gentleman that I know. In the last 10 years, he's refinanced 7 times.
Mm-hmm.
So I told him once, you know what? If you refinance 7 times in the last 10 years, and of course your rate, and of course at the final refinance was at 2.5 or 2.7 that he got. But what I was trying to tell him is, yes, you're going to save a lot of money by going to 2.5 or 3, but your 10-year that you started, now you started another clock of 30 years. So you paying interest of up to 40 years. I mean, does that add up to a lot of interest? I mean, am I,
Yeah. Now, I do want to play devil's advocate here because there is some positive to this. There are a lot of first-time buyers that I talked to. In fact, I just talked with one this evening, right before this call, that are having trouble qualifying because the interest rates are higher and they just can't, they don't make enough money. And that extra, let's say it's $100 a month cheaper on the 50-year, and their debt to income ratio can remain within the threshold that they allow. With the 50-year, it could make sense. But if someone's doing that, they have to be disciplined and make more than the minimum payment. Because if you take a 50-year loan, you don't necessarily have to take 50 years to pay it off.
Okay.
You can, let's say, 14 payments a year on, and probably pay it off pretty quickly, about 20 years or so, I would guess, 25 years. So it could get someone in the house, especially someone that, let's say, is having trouble qualifying now, but they know for a fact they're going to be making more money in the future or whatever. It could be helpful there. And the other scenario where I can definitely see it being helpful is investors. If you're buying a rental property and you're looking for monthly cash flow, well, that's $100 a month more of monthly cash flow. And you don't really care about the equity portion when you're buying for cash flowing rental.
Right.
So that's a scenario where I could see this making sense as well.
Yeah, absolutely right. Let me see here. We have a question, so let's answer that. Mrs. Simmons again. Are there any pros to this 50-year mortgage? What age group is being targeted?
Well, I mean, the pros I just talked about. I think I just answered that question. As far as age groups, there's no age group being targeted. It's in fact, it would be against the law for them to target a specific age group. So in theory, anybody would be eligible. Even an 80-year-old person could take a 50-year loan. And the way that works is the loan doesn't go away. When they die, their estate will owe the money. So they'll still get their, it'll just be paid off whenever the person passes away. But it could be argued that if an 80-year-old person takes out a 50-year loan, there's not going to be much of a legacy for them to leave their kids, in terms of leave them
with debt. They're going to leave them with debt.
So that would fall into the category kind of like reverse mortgage and stuff, where they chip away at their equity. It's,
right. Here's the way I look at it. And Mrs. Simmons, to answer your question, this is targeted for people who can I think this is targeted to people who cannot afford a home right now. And the administration or the housing industry wants people to be affordable, right? But here's the catch, or here's the bad thing, the con about it is, if I'm a buyer and I'm pushing and shoving to buy a house at a 30-year mortgage, and I'm waiting for the 6.6 to come to 6.6, I'm stretching myself to buy a house in the first place. And the way things are going with the increase in property taxes, the increase in insurance, the increase in HOA, the increasing medical insurance, medical premium, everything going up, one should not push and shove to buy a house. Now, here comes a 50-year loan. Now you're pushing and shoving. It's going to make it a little easier, but it's putting the consumer in more danger about having default. That's my opinion. If you can't afford a 30-year mortgage, don't jump into a 50-year mortgage because you're asking for trouble. That's my personal opinion. Mathematically speaking, strictly mathematically speaking.
I would agree. Yep. And I'm just putting my my contact info in the chat in case anybody
Sure, absolutely. And I'm going to share a screen while you do that. So let's talk about that while we're waiting. I'm going to share a screen here. It's from realtor.com and see what they say. Let's see. This is realtor.com. You can see that. So I'm going to read it while you do that. Let's see here. So this came out obviously yesterday because this was announced yesterday and the news already came out. It hit fast. Trump proposes 50-year mortgage, potential benefits and drawbacks for home buyers. Federal Housing Finance Agency Director Bill Pulte, that's who I was looking for. That was the name.
Yes.
Pulte Homes. I should have known it was Pulte, the owner. The nation's top mortgage regulator seemed to confirm that plan in a post on X, Twitter, writing, "Thanks to President Trump, we're indeed working on the 50-year mortgage, a complete game changer." And here's the pros that you are looking for, Mrs. Simmons and others that are watching. For home buyers, a 50-year mortgage would offer lower monthly payments compared to a standard 30-year loan, but total interest paid would be much higher over the lifetime of the loan, and homeowners would gain equity at a slower pace. Those trade-offs have sharply divided reactions to the plan, with critics calling it a bad deal for home buyers that would benefit only lenders and drive home prices higher, and supporters arguing it would give home buyers more financing options and flexibility. So it's a trade-off, right? I mean,
and actually getting to that point of driving prices higher, any potential gain a benefit in terms of affordability would be erased by, because I assure you, if all of a sudden more people can qualify, the supply side of the equation is not being altered in this.
Right.
It's only the demand. So if the demand increases and supply remains the same, prices will go up.
Right. Okay. Yeah.
Which
Let me
will
try to share
offset
the screen here. Let's see here. All right. No, I was just trying to see here. Matthew, I had sent you this earlier. I don't know if you had a chance to look at it, but let's look at the interest rate. A 50-year mortgage would come with a higher interest rate, right? We were talking about it. A 15-year loan is cheaper than a 30-year loan, at least the interest rates. And the 30-year mortgage interest rate would be cheaper than a 50-year, which means the 50-year mortgage would be higher. So even, you may be saving $100, $200, $300 on a $500,000 loan amount. That's not very high. And I would strongly not recommend to do it. Of course, that's my personal opinion. I'm not a lender. I'm not your advisor, but if you're watching this, this is my personal opinion. Talk to your financial planner, accountant, or lender for you to make any decision. But this is my thing. I'd say don't get into a 50-year loan. Right?
Yeah.
I'm saying it loud and clear.
For most people, I would agree. I don't think it's a good product. Like I say, for investors that are looking for cash flow and possibly for very one-off scenarios of someone that has less income now and knows for sure, like let's say it's a doctor, let's say somebody who got out of medical school, they know they're going to be making bank. But they've got it right now. They're still doing their residency or whatever, and their income is lower, but they want to buy a house. For someone like that, I could see it being a thing to get them in a house. And then when they start making that additional money, as long as they are diligent in chipping away at, paying it down faster,
right,
or refinancing it, at that point,
absolutely,
it could make sense.
Right.
But those are very, very specific scenarios. And this is being sold to the public as, oh my God, this is the solution to the affordability problem that we have.
Right. No,
and
it's not.
Yeah.
So where do you feel? So here's my take on what will happen to the prices. Okay. First of all, according to NAR, they released stats about 5 months ago, I believe in August. They said that if the rates drop to, at that time it was 6.5, and they said if the rates drop 1% to 5.5, not from 7 to 6, but from 6.5 to 5.5 range, they say that a pool of almost, was it 2 million buyers, 2 million home buyers will come into the pool because all these people can all of a sudden qualify for a medium price home, which is around $430,000, right? But my take is if this many people, buyers come into the market, there's going to be multiple offers, And if there's multiple offers, sellers are going to say, wow, hot diggity, we're back to 2022, 23. They're going to jump the price. So yes, a lot of people will be able to afford the homes. A lot of people will come in the market, but within 2, 3, 4 months, home prices will go up. So we are back to square one.
Yeah, the only thing I would say in counter to that is there's also a lot of home sellers that want to sell their home. Maybe the home they're in is not right, but they feel like they don't want to give up their 3% mortgage, but at 5.5%, to buy a new one at a higher rate. But when it gets down to that 5.5% threshold, it might be enough to cause those sellers to enter the market as well, which would create more supply. But most of those sellers are also going to be buyers. So they're going to kind of cancel out in a lot of cases.
And to your point, most of those sellers are age 40, 50, 60, right? Second time home sellers.
Mm-hmm.
If they get a 50-year loan, they're going to be paying till 80, 90 years old. Unless they refinance when the prices drop. But we assume everything, right? It's a 50-year mortgage. You're going to pay for 50 years, right? We have to assume that. They're going to be
go 100 years while we're at it.
Well, more and more seniors are being forced to go out and work today because of the economy, because of the tariffs, because of the home high prices, because of slightly rising inflation rate. More homeowners, senior homeowners who have been retired, who are on fixed income, are forced to go out and work.
Yeah.
It's a sad, pathetic thing, but things that are happening out there today, that's what's happening out there. I feel sorry for I've taken Uber drivers sometimes, and the drivers are seniors. They say, I'm forced to work. They're on fixed income. The property taxes went up to the roof. Insurance went through the roof. The groceries that they can't afford because they're fixed amount, they have to go to work. The medical premiums went up. Even if they're on medical or Medicaid or Medicare, they still have other costs. Not everything is covered by Medicare or Medicaid. So there is still additional cost, not to mention maintenance. So the 2x4s cost a lot more, and you call a handyman, they're going to charge you $100 just to show up there. You know? And not even a contractor, a handyman. I called one the other day, and he said that my bill is going to be $325 for a toilet fix. A chain broke. The chain was $20 because he went to Home Depot, charged me for gas. I said, fine. Then he said, I'm charging you for an hour, $80 an hour. And then he charged me $100 for coming in.
Yeah.
Never heard of that. I paid the guy because it was a tenant occupied. I had it fixed, and it was my rental property. Didn't have time to argue because I needed it fixed. But
that's why I have rental property, and that's why stuff like that, I go to Home Depot myself and put the chain in.
Yeah.
I don't have people for most stuff. I am the plumber and the electrician.
Yeah, right.
Rentals.
Right. Okay. I just got a message. So yeah. Okay. Okay. Let me go down this chart here and look at another chart that we can discuss. So Matthew, if the current rate is 6.2 on a 30-year fixed, right? What do you think is going to be on a 50-year mortgage? Is it usually half a point, or is it standard?
Well, just based on the difference between the 15-year and the 30-year,
right?
I would guess it's probably going to be about 0.5% differential.
Okay.
So if it's 6.25, figure 6.75.
Right.
And that's just a guess. There's no real way to know. It could be that going from 30 to 50. Yeah, it'd probably be about that because it's almost double. It's almost the amortization time.
Right. Okay. But let's look at this. This is, by the way, these charts are from Resi Club, and they get their data from other sources. But what they're saying is lenders charge more for long-term loans because they take an additional risk. The further out the repayment period stretches, the greater the uncertainty around inflation, interest rates, and credit risk. Historically, the 30-year fixed mortgage rate has averaged about 57 basis points higher than the 15-year rate. If a 50-year option were introduced at scale, borrowers could expect an even steeper premium, likely adding another fraction of a percentage point to the rate in exchange for a lower monthly payment. Let's look at this graph. The average 30-year fixed mortgage rate as tracked by Freddie Mac came in at 6.22 last week. At that level, the average 50-year fixed mortgage rate would be somewhere between 6.64 and 6.79, as you mentioned, half a point or so, assuming Motsashami's additional premium is correct. So let's look at these. I'll let you discuss this. What are you seeing here, Matthew? Whoops.
Well, the numbers are kind of small.
Okay.
But
Well,
it
let me
looks
read
like
it out. Let me read it out if you want. The hypothetical monthly principal and interest payment on a 400,000 mortgage. If it's a 15-year fixed, your principal and interest is 3268 at a rate of 5.5%. For the same loan amount on a 30-year, the rate would be 6.22 as it is around today. Your payment will drop to 2455. But at a 50-year mortgage, your rate will go to 6.64 and your payment drops to 2297, which is not a whole lot.
Yeah. So this graph is kind of showing, you can see the blue and the yellow are not that different in terms of the bar graph.
Right. Yeah.
So in terms of that little difference, that's your monthly savings. And it comes at a big price, as you pointed out, in terms of how much extra interest you're paying over the life of the loan.
Exactly. Right. Right.
So that kind of, this is a great way, this bar graph is a great way to illustrate who's really benefiting from this.
Right. Right. Yeah.
What is the real MO behind this? It's not to help people, help homes be more affordable or help the working class person.
Right. Let's look on the flip side, and I'm going to take out this. Well, I'll leave this screen here. Let me remove the screen for now. I want to discuss about who benefits more, the buyer or the seller. So let me give you some key points, and we can discuss on it. The bigger picture: who will actually benefit from a 50-year mortgage? Number one, developers. Number two, banks and lenders. They will earn more interest for decades.
Well, and even loan originators like myself.
Exactly.
As much as I'm against this, if they do it, I'll probably benefit from it because I'll have more people that can qualify. And
That's right. The third one is politicians. Politicians claim they fixed affordability on paper. I don't think it'll fix affordability. It will make it worse. But that's my opinion. And then the losers will be the buyers and the average homeowners. That's not me talking. This just came out 1 day ago. So I'm looking at reports, but this is the average or the consensus, not me talking. But we talked about developers, the banks, the politicians, and the losers are buyers. What's your take on it? What would you like to discuss on it that hits you the most, Matthew, on this?
Well, I mean, we've kind of discussed most of what there is to say. I wish we had some questions from our audience.
Right. Okay.
Guide us on what else, where else to go with this.
Okay.
But
if you have any questions, hey, if you have any questions, we're here to answer. This is pretty brand new. If you have any thoughts or pros and cons, let us know. Type it in. We'll be glad to answer it. In the meantime, how would developers benefit from this? And I have my take on it. And when I say developers, we're talking about home builders. I have my take on it, but I'll let you answer that, and I'll answer also. How will a home builder benefit from lower? Well,
home builders could benefit from it in a number of ways. First of all, more people will qualify to buy their homes. So it's gonna be easier for them to sell their inventory because they can put people into a 50-year loan and make it supposedly more affordable for them.
Right.
So they'll benefit in that way. And depending on if these loans extend to commercial type loans, they could benefit developers tremendously if the developer is able to fund their construction and purchase of the land with a 50-year loan. That'll keep their monthly costs down to fund the property until it sells. Right. So I could see them benefiting that way as well.
Right. Here's my take. Like I said, I had a TikTok live today, and if you guys want to watch that, you can go to my TikTok live. The channel is Mike Moves You, and I did a 45-minute live focusing it on buyers. So take a look at it if you like, or direct message me and I'll send you a link. But here's my take on home builders, how they will benefit. And what I said this in the TikTok live, and I use the same analogy, is when a buyer buys today, he buys a refrigerator, appliances, a car, or a house. They base the purchase on monthly payments. Can I afford this refrigerator? It's $250 a month. Can I afford this car? It's $500 a month, right? They don't look at the price. Same thing with the house. My take is when a buyer buys a house based on the down payment, the interest rate, the purchase of the home, lender's going to say, okay, Mike, you can buy something that's around $3,000 a month payment. I'm a builder and I have a house right now. And it's, if a buyer buys it, Matthew, if you're a buyer, I'm going to say, you know what, Matthew, if you put 10% down, blah, 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 your payment's $3,000 a month. And the price of the house is $500,000. Now there's a 50-year loan. So I'm going to advertise, hey, buy a house at $3,000 fixed for 30 years. And they buy it. But guess what? The house price will be $525 or $530 because they can get away with it because they're keeping the payment same. So they're charging $525 instead of $500 30-year mortgage. They're charging $525 or $530. Give them a free carpet or whatever, which doesn't cost them anything. And they're getting away with murder.
Yeah. And I could see that happening not just with developers, but resale homes as well. If you're selling your house and, people are still basing what they will pay for your house based on what the monthly payment is.
Mm-hmm.
Monthly payment's lower, you're going to be able to command a higher price.
Right.
So.
Okay. So when it comes to refi, what will happen when you refi? I mean, from a 50 to a 30, you the lender. So, I'm trying to understand if I have a 50-year loan at, let's say 7% or 6.8, according to the example, after 3 years, my income increased. I got a bonus, I got a promotion, blah, blah, blah. When I go to a 30-year loan, just like going from a 30 to 15-year loan, it's a big payment difference, right? So,
your payment's going to go up.
Right.
But unless the interest rates go way down to enough to compensate for the extra payment. And the other thing that people, don't realize a lot, there are people that are in 50-year loans right now. And
there are? I thought there was no 50-year loans out there.
Well, not officially, but indirectly.
Right.
And the way they do it indirectly is people don't think of this, but when they refinance, if you have a 30-year loan and you're 10 years into it and you refinance, okay, and you refinance for another, like a 30-year loan again, you just reset the clock. So you spend 10 years paying down the loan and getting to the point where you're paying more principal each month. And then you refinance to get the lower rate, but you choose a 30-year loan instead of a 20-year loan. So now when you reset the clock, you essentially now have a 40-year loan, because you had a 10 and then you reset it and have another 30 after that. So
right.
it's kind of the same thing.
You're absolutely right. So for those people who refinance 3, 4, 5 times, if you do the math, you're paying a lot of interest because now, if you like, I had a question this morning on my TikTok live. Say I paid 10 years. No, 50, how much was it? 12 or 15 years. I paid 15 years on the loan, but I need money to remodel. I have to extend because my family is growing and we don't want to move. And he asked me what I should do. I said, well, I don't know much about it. And on the live, I could not answer it. But the one thing I said is, you've paid 15 years. One thing I would not do myself is I would not start again for another 30-year mortgage.
Right.
Instead, I said, get a HELOC loan, home equity line of credit, and pull just enough to build your extra room or kitchen, whatever they wanted to do, $50,000, $60,000, $70,000. And then when you get that loan on a HELOC, try to pay off faster and faster. But don't take away your 15-year loan and start another 30-year loan. That's kind of what I said. What would you have said? I mean,
Yeah, and it really depends on what the interest rates are. If the market interest rate is substantially lower than what they currently have on their loan, then they could, it would make sense to do a cash out refinance. But if not, then the home equity line would be a better way to go and keep the initial the initial loan at the original rate if it's better than market rate. So kind of depends on that. But you can do a loan for any period you want. You can do a 10-year loan, 15, 18. I mean, you don't even have to fit into a bucket. I can make someone a 17-year loan if they want.
Right. But here's a thought, and you just mentioned 12-year, 14-year. We have a question which we'll answer. AK, thanks for the question. We'll answer it in a minute. So here's a question, Matthew. If I can barely afford a 30-year mortgage and I opt to go on a 50-year loan mortgage, right? Why don't I take a 5-year, 7-year fixed mortgage or an adjustable mortgage, which is lower, and then refinance instead of refinancing the 50? How does that make sense?
Well, if you take an adjustable mortgage, you're rolling the dice that the rates might go up. So that's the thing. We do have a good question from AK, whoever that is. If this is the wave of the future, what benefits do you have as a homeowner? Well, we kind of addressed that part of it. What benefits do you have to own a home? In other words, why not just rent? Because a 50-year mortgage is basically the same as renting because you're never going to actually pay off the home and own it. You're just renting from the bank, essentially, is what they're saying. And yeah, I mean, it in a way, it is less of an ROI to be a homeowner. It takes away some of the benefit of it. I would still argue that there is still, because people come to me now and they ask me, the rent versus buy, and this is like a different topic, but related. I get asked this a lot, like, it's cheaper to rent right now in many cities. You could get the same house, you can rent it for $3,000 a month. It might cost you $3,400 to own it, right? And they ask me, why would I pay more for the same house? I'm just going to keep renting. But the foolishness of that is if you're going to be there for a long period of time. See, in the short term, if you're only going to live in the house for a year or two, then absolutely that rent versus buy is heavily weighted towards the rent side as the better option. But if you're more long term and you look forward 10 years in the future, let's say, what will happen is generally rents are going to go up. So when you buy with a fixed rate mortgage, your payment remains the same. So day one, you've got a $3,000 a month rent or a $3,400 a month homeownership payment on day one. But 10 years later, do you think your rent's still going to be $3,000 for that house? It's probably going to be $3,800 or $4,000. But when you own it, your payment is still $3,400. So the longer you stay in it, the more the owning becomes a benefit. You benefit more than by doing. And same thing here. The benefit, even with a 50-year mortgage, would be really if you take a 50-year mortgage, you have to plan on paying it down quicker. It's very foolish if you don't.
Right, but the question is, they're getting a 50-year loan because they can't afford it in the first place. And my take is, unless you know for sure that you're going to get a substantial increase in your wages, and for 99%, that's not true. So if you're talking about the average people who cannot afford it, I think it doesn't make sense to me. And we're talking about the average guys. I mean, this is for people who cannot afford it. The whole reason for the Trump administration to bring this out or to float this out is to bring more affordability.
Right.
I don't think this is the right way.
Not for those people. The ones who will benefit the most are the ones that have a lot of money and are going to, working with investments and stuff like that. And AK also commented there and said, a good answer, but and pointed out that it's sort of like rent control. So yes, owning versus renting is it's like having rent control, because your payment is going to remain the same. And also, the longer you stay there, the more especially if you don't have a 50-year mortgage, you start chipping away at the equity. And after 30 years of staying in the house on a normal loan, you have zero rent, which never happens if you're a renter. And this is why, even for investors, will buy a rental home that is negative cash flow right now. They will buy a house where their monthly carrying costs are $3,400 and turn around and rent it out for $3,000 and lose $400 a month, plus have all the headaches of owning the rental property. But they're smart because they know that as time goes on, that is going to shift. And 10 years later, when they still own that property, they're going to start cash flowing and they're going to be making money on it every month with predominantly the bank's money. So.
Right. Okay. I want to, you mentioned earlier that this will benefit rich people. You mentioned something like that, right? Let me go back what we discussed earlier. Remember, I read 4 points. The bigger picture, who actually benefits? And I'm driving a point here. Number one, I said developers and home builders. I didn't say this. This is what the research showed within one day that I kind of dug out. The banks will benefit and lenders. The politicians, the losers are buyers and the average homeowner. So my take is, and I said earlier, and even on my TikTok show, I said, this is not a good product. So to answer your question, or to reiterate what you said and reiterating who benefits to, this 50-year loan is disguised as an affordability for the people who cannot afford it. But the biggest people who will benefit are the rich and the rich and the richer. Isn't that we concluding? I would
agree with that statement. Okay. Yeah.
I end my case. No, we're not in court, are we? No, no, I really feel this is a bad product. I mean, I'm going to drive that home. If you get it, fine. I really think it's a bad product. It's not made for the consumer who cannot afford a house. If you cannot afford a house, don't buy it. Or if you cannot afford a $400,000 house or a $500,000 house, get a $300,000 house. If you can buy a house that's a 4 bedrooms, 3 bath with a yard and a view, get a fixer, get a smaller house, but don't get into a 50-year loan. That's how strong I'm saying, because if you're pushing and shoving to get a 30-year mortgage and you get a 50-year loan, you're asking for trouble. I'm looking at short sales, REOs. Last year, or as of August this year, there was up to 2 million FHA loans in default. These are people who bought 2 or 3 years ago, and the property taxes went up, insurance went up, cost of living went up. They're behind 2 million. That's not even counting conventional loans. Imagine you shove these guys into a 50-year loan and they lose a job. You're going to see tons of defaults, tons of short sales. Guess who will buy these bank-owned properties? The rich.
Exactly.
So this only benefits the rich. Sorry for saying that.
It's another transfer of wealth.
That's all it is.
And you know what? Even the other stuff that the administration's talking about, I've heard them talking about, forcing. Trump always says he wants to force the interest rates. He's going to put a new Fed chairman in who will lower the rates down to 3%, immediately, because too late Powell isn't doing it, right?
Oh, by the way, just a disclosure, what we're talking about, and I know we mentioned Trump administration, this is not a political comment.
It's not.
It is strictly mathematical. We're talking numbers, and it makes sense. So just if you're watching red, blue, purple, whatever you are, this is strictly a mathematical conversation that we're having. Nothing to do with who's good, who's bad. But mathematically, the unaffordable people are not going to be able to afford it. And mathematically speaking, it only benefits the builders and the rich and the investors. In fact, one of my friends who I play golf with sent me a text yesterday and said, guess what, Mike? Look at this. And I didn't hear about it, right? And the first thing I said, I'm going to buy a house. Instinctively, I said that because I can afford a house as a rental.
Mm-hmm.
I didn't say, oh, good, I have a buyer who cannot afford it, I'll go show him a house. No, I'm going to buy a freaking house.
Yeah.
So,
Yeah.
quote, the rich will benefit, not the regular guy benefiting, you know?
Yeah.
So, yeah.
But like I was saying, if they were to, let's say the Fed decides to lower interest rates back down to 3%, okay, to help right now, it's kind of like everything that they're proposing might have a short-term benefit now, and we'll all be partying, but there's going to be a hangover from it. And the 50-year mortgage is it's another thing that there may be some short-term benefits and people might feel richer or whatever, but there's a hangover effect that's going to be when you go to refinance, when you go to sell and you have no equity. That's where you're going to feel the pain. And that's why, and the 3% mortgage rates will be great initially. I'll love it because I'll be refinancing everyone and making a killing.
Right.
But that's going to cause inflation, which ultimately is not a good thing.
Right. Right.
So
Here's another question. So remember, and you know better, a lot of times the lenders, because they're taking a risk, they're giving a good product, good rate, blah, blah, blah. There's a penalty or prepayment penalty for refinancing a certain amount, 1 year, 2 years, 3 years, right? Some do, some don't. What do you expect some restrictions will be? Because if I'm a bank and giving you a 50-year loan, taking a big risk, I don't want you to refi because I don't make any money. I don't want you to refi in 6 months or 7 years or 7 months. I mean, if I'm a bank and you're saying that the new Fed is coming in May and he's going to drop it to 3%, how will they make money? They
they do want you to refinance frequently, but not too frequently. Because every time you refinance, they charge closing costs again.
Right.
So, but in order to get their money's worth out of it, you've got to keep it. Most wholesale lenders that I work with have a rule that if I do a loan for someone and they pay it off or refinance it and pay off that loan within 6 months, it's usually, it's 6 months is about what it is, that I actually have to pay them back any of the commission that I earned on doing that loan.
Really? As a lender on the back end?
Yeah. So I've got to be very careful with that. When I talk to people and they're like, well, I own a home and I'm going to sell my home, but I just want a loan to buy first. And then as soon as my old home sells, I'm going to pay it off.
Right.
When I hear that scenario and they're trying to use it like a bridge loan, that's when I have to have the conversation with them. And I'm like, we can do that. Mm-hmm. But I beg of you, as long as you're happy with me and if I become your enemy, then all right. Yeah. But if you like me, please wait 6 months before you pay it off.
Right. Yeah, I know. Yeah,
that's what the conversation I have to have.
I'm going to share something on the screen. Let's discuss that. Then after that discussion, I want to talk about the real fix for affordability. This is a fix for affordability or non-affordability. So let's talk about those things. But I want to look at this chart and see if you want to discuss this. It says, let me see. Let me go back here. How respondents initially reacted to the news that the administration is working on a 50-year mortgage option. In total, 2,373 individuals responded to the poll conducted by Resi Club's editor-in-chief Lance Lambert on X.com. The survey was fielded on November 8, 2025. Okay. Very favorable, 65%. Somewhat unfavorable, 15.8%. Somewhat favorable, 11.2%. And very favorable, 7.2%. So it's totally opposite. I thought a lot of people would not like it, but they're liking it.
Yeah, well, they like it because I think, unless you're in the industry and you're constantly crunching numbers and looking at amortization tables and understand the facts that you just pointed out with real concrete numbers, unless you see that, it sounds on the surface like a great thing. Mm-hmm. But when the devil's in the details, when you really look at how much will it actually save you or cost you, And that's probably why, because even I'll admit, when I first heard it, I was cheering. When I first heard about it, I thought, what a great thing that. And then I started crunching the numbers like you did. And I'm like, well, what's that going to do? Save $100 a month, but you pay an extra $150,000 for the house?
Well, let me make this podcast even more painful. I'm going to put this screen again, and I'm going to say it again. If you buy a $500,000 loan amount, or a finance $500,000 loan amount with a 30-year loan at 6.2, you are paying 1.114 for the house total, principal and interest over 30 years. But if you get the same house on the same loan amount, I mean the principal amount, or the loan amount, I'm sorry, on a 50-year loan at 6.8%, look how much you're paying for the house, 1.7. In other words, to save a $200 or $300, in this case, it's about $200, you're paying $500,000 more for the house, mathematically speaking. You tell me that's good or bad.
Yeah. Oh, it's definitely bad.
Driving that point home. I mean, I think it's ridiculous.
Yeah.
Totally ridiculous.
Yeah. And it's a similar argument between a 15 and a 30 year.
Right.
That we have now. When you look at the difference in the amount of interest you pay on a 15-year loan versus a 30, and it's substantial.
Well, let's do that. Let's go 15 years.
Yeah.
And what interest rate should I put? We were basing it on 6.2.
Yep.
Well,
but there is a trick that I recommend for people in this, but go ahead.
What, 5.7 rate or what? For a 15-year?
Yeah, let's just say 5.7.
Let's see what it comes out to. Yeah, look at the drop. Wow.
Yeah.
You're paying 744 compared to 1.14 on a 30-year and if you have a 15-year loan, you're paying $1 million less for the loan. $1 million.
Right. But there is a good balance, and people, when they ask me, should I go with a 15 or a 30 year, my advice to them, and that I follow myself when I take out loans, is I always go with the 30. Okay. But I don't take the full 30 to pay it off, because if you take a 30-year loan and you make 13 payments a year instead of 12, that's just one extra payment. It could come in the form of 1/12 of your payment each month added, or a lump sum once a year, an extra payment. Either way. And some people do it where if they get paid every other week, there's 2 months where they get 3 paychecks. So if you sync it up with your paychecks, you'll end up making 13 payments. You do that, your 30-year loan will be paid off in about 22 to 23 years. So you shave off 7 or 8 years of making payments and an awful lot of interest.
Absolutely.
By doing that. But by taking the 30-year, the amount that you have to pay each month is lower.
Right.
And so it's smart to do that, because if you do fall on hard times, and let's say you lose your job or whatever, the amount, to stay afloat, it's less of a burden on you at the 30-year loan. So to me, it's worth paying that 0.5% extra in the rate to have the flexibility, but have the intention of paying it off much faster than 30 years. Right. That's the smartest way to do it.
Yeah, that makes a big, in fact, I do that ever since I got my 15-year loan. I refinanced in 2016 from a 30-year loan. I had 2 car payments. I had a first and a second, and I had a lot of credit card bills. 2015, 2012 was a tough year for a lot of realtors. So my credit card got full up to $40,000. So in 2016, a friend of mine, Linda, called me. He said, Mike, it's 3% interest rate with a cash out. So what we did was we refinanced the second loan. I had 4 car payments, 2 of me, my wife, and 2 kids in college, 4 car payments, and had a $40,000 credit card bill. My total payment I used to pay was at that time $4,600 a month. So when we refi cash out at 3% for 15 years and paid off the cars, paid off the credit cards, and only had 1 loan, my payments dropped to about $3,200, from $4,600 to $3,200, but now I only have 15-year payment. And I've got 4 more years to go, and I've been paying $200, $300, $400, $500 a month extra whenever I can.
Right. So you'll have that paid off in no time.
Yeah, I'm going to say 5 years.
Yeah.
So it does work. So that system is absolutely works. I've done it. And a lot of every home I sell, I'll tell the buyers, do me a favor, 50 bucks, 100 bucks, $500, whatever you can pay extra. If you have $1,000 extra check or a bonus, 10,000, 5,000, send it to your bank, paid off. Instead of 30 years, you'll be done in 20 years.
Mm-hmm.
And a lot of my clients do that. I have one friend I sold house 20 years ago. His house is paid off. He thanks me all the time. So thank you.
Yeah.
I refinance, so I'm still paying. I've been here 25 years, but during recession, a lot of bad things happen. I had to refinance twice, so I'm still have a payment. Otherwise, I would have been paid off.
Yeah.
Sad story, right? But hey, I'm not complaining. I'm just saying, you're a realtor? Why aren't you not paid off? Well, 2008 threw me off.
Yeah.
Like it did a lot of realtors.
The other advice is, like I said before, when you do refinance to get a lower, let's say a lower rate is available, try to consider how many years you have left on your amortization schedule for your loan and make your new loan have the same number of years left on it. Don't reset the clock to 30 years starting over.
Right.
If you keep doing that, you basically have a 50-year loan.
Right.
So
going back to the original question, if you're watching live or if you're watching a recording, the question is, would you rather see lower home prices or longer loan terms like 30, 40, or 50-year loans? Let us know in the comment below right now. We can discuss about it. Or are you for it for a 50-year loan, or you think it's good or bad? So let us know either way. So what we want to talk about, Matthew, I mentioned earlier, is what are other solutions? This is a solution to reduce unaffordability.
Mm-hmm.
And I did some checking around, and here's some things, real fixes for affordability. Let's discuss some of those. Let me read out 3 things, and we'll discuss 1 or 2 of those things. Number 1 thing is policy ideas that make actual sense. Number 1 is raise the capital gains exemption from 500,000 to 1 million for married couples, which encourages more people to sell. Especially in California, everything is over $1 million, and people bought it for $200,000. It doesn't help them. A person who bought 20 years ago in Idaho or Nebraska, they get the full benefit of $500,000 if they're married. But in California, it doesn't really help that much. You're still paying a lot of taxes.
Right. That makes sense.
I'm talking to a seller right now. He bought his house for about 1.2 20 years ago. Right? It's worth over $4 or $5 million, and he's not selling because he said, I'll have to pay a capital gains on $3 million.
Yeah.
And that's
I mean, in my market, that's not as big of a thing because very few people are making, more than 500,000 on their home as a married couple.
Well, you look at Bay Area, you look at Chicago, you look at New York, you look at the metro areas, the big homes are $1 million, townhomes are $1 million. They all have a lot of capital gains tax, and a lot of the owners have been there a long time. So that's what they're suggesting. So that's number 1. The second thing is they're saying is allow mortgage portability. Take your low rate with you to a new home.
That would be amazing.
Okay, let's discuss that.
Do that with the existing loans because the investors that made those loans, that's not part of the terms of the loan. You can't modify it.
Okay. So you cannot take it to another house or
they can originate new loans that are portable in theory, but they'd be at today's rates, and you'd probably pay above market for the portability aspect.
Right.
So
would this something be possible in the future if they bring it? One of the politicians gets to know it and gets to do it. Is that a possibility?
It is a possibility, but I don't think. I think the investors that fund the loans don't want it. So usually the ones who have the money control the outcome.
So that's not going to happen. Okay.
Probably not.
Right. The third thing is expand mortgage interest deductions for new loans issued after 2026. That's what they're saying. I don't know how that makes sense.
Yeah, I mean, the mortgage interest deduction is, at least in my area where the mortgages aren't as high because the homes aren't as expensive. Like I don't even itemize anymore. During Trump's first term, one of the things that was changed, which is maybe a good thing, I don't know. But they increased the standard deduction so that for most people, it doesn't make sense to itemize, which
Okay.
simplifies the tax return. But then I don't get the benefit directly of mortgage interest deduction because I'm not itemizing. And even if I itemize, I'm not going to get more than the standard deduction. So,
Right. Okay. That's a possibility. The next thing is, here's what they're saying. The real market fixes. This is what you got to do. Number one is have more inventory. Of course, you cannot control it, but do something so that sellers, like you were saying earlier, the current homeowners sell to buy another one that brings more home in the market. Give them downsizing incentives. If I have a big house, like I have a 4-bedroom, 3-bath, it's just me and my wife. Why should I move to a single story home or a smaller home? Well, unless there's an incentive, I might. Hey, Mike, move to Arizona. We'll give you $100,000, blah, blah, blah. I may consider it, right?
that's a great idea.
That's a great, hey, I'll move for 100,000 or whatever. I mean, they have to come up with something. And then it says better financing literacy. I don't know what that means, but that's what they're saying.
That means more people have to watch your live streams.
Yeah, exactly. And I have to watch more live streams so I can, because I don't know that answer myself. I got it from some reports, but sorry about that. It says real market fix and better financing literacy. I mean, we are getting educated, but more things come out. I learned a lot from you today. Okay, so let's go for tips for buyers. What are some of the tips? And I mentioned earlier, it says buy less, not more.
Mm-hmm.
Do you want to expand on that? I mean,
well, it sounds like what you're saying is don't get in over your head. Buy what you can afford, even though a lot of people can't afford anything these days. But stay within your affordability. And the other thing I would say is it is beneficial to own a home versus renting, but not everyone, you don't have to rush to get there. Earlier in your life when you're, struggling financially and just getting started, sometimes it does make sense to rent a little longer and delay your purchasing. So that would be another.
Can I give the buyers some tips, especially the young guys? Give them a good tip. Be nice to your parents. Be nice to your uncles. All these boomers, they have a lot of money. They have a lot of savings. They have a lot of assets. And it's passing down. If you're not nice to them, you won't get them because it does happen. So be nice to your parents, to your uncles. They got assets. And I'm talking in general. There's trillions and trillions of dollars. In fact, I did a video coming out in 2 weeks. There's $74 trillion worth of assets in boomers, and drops down to Gen Z. It was like 34 trillion. And then the Gen Z or whatever, the youngest age, they were at 19 trillion. So compare 74 trillion to 19 trillion.
There's a big gap. And part of that is for the past, 40 years or more, we've been living on debt. So that deficit that the country has is basically causing inflation, and but people with assets, people that own real estate, people that own the boomers that have the assets are benefiting from that because all their assets are going up in value at a rate faster than ever before.
We're talking homes, properties, we're talking stocks, we're talking 401ks, we're talking all kinds of stuff. We're talking jewelry, cars, homes, you name it. These boomers, if you look at the current millennials and the Gen Zs, they go to Starbucks, they buy the latest Oakley, they have the iPhone 17 waiting, they get it, they pay retail. I never pay retail, that's how I am, unless I have to. But what happened during the boomers, and I'm a boomer myself, there were tough times. They were taught to not spend too much. They were taught to save. So they have a lot of assets because they did that. They bought a house, they kept it. They bought stocks, they kept it. They didn't sell the stock and go buy a $1,000 Nike shoes.
Right. Yeah.
I was going to say something, I better not. How I feel about it. You know how I feel about it, right?
Yeah.
But the current generation.
I'm and I feel that way also. But but
the current generation is not doing that.
Right.
But the boomers, my generation, they saved a lot of money. They learned the hard way. They didn't buy those iPhones. Not that they were available, but even the regular phone, they didn't blow money right now. What's the stat right now? What's the average saving right now for an average homeowner? $10,000 or less?
Yeah, very low. Very
Look at
low.
where we're headed. And now you're saying give them
the average person has more debt than they have savings. They're like negative.
and then you're telling them to buy a 50-year mortgage. Come on, it doesn't make sense. It does not make sense, because if they lose a job, they're going to lose the house.
Right. Yeah, and that's why
If they're stretching as it is. They're not stretching, they're overstretching on a 50-year loan. Now they lose a house. They're 1 or 2 paychecks away from losing that house.
Right. Yeah.
Buy below your means, or don't even buy it, rent for now and collect more money and then buy. Wait 5 years. You're going to leave 10 years more, 15 years more anyways. What's 3 or 4 or 5 years extra to buy a house going to be? So be very careful. I'm sorry I'm saying that, but I feel very strongly against a 50-year mortgage.
Yeah. Yeah. I hear you.
Okay, let's see. Okay.
It says BS. Boomers bought POS caddies. What is that? I don't know what a POS caddy is, and retired in their early 50s after their greatest generation parents gave them all the money they saved. Well, I don't know. I don't know what a POS caddy is. Maybe Edwin can clarify. But do you know? Maybe that's a boomer term.
You can look it up, ChatGPT.
Cadillac.
I can't.
Cadillac.
Oh, it says Cadillac. Edwin Cadillac.
Yeah. Okay.
POS caddies. Okay.
And I don't know what a POS caddy is, but
it's a Cadillac. Okay.
Well, yeah, it's kind of retired in the early 50s.
Yeah, but how many did the Cadillac cost at that time? $5,000 compared to their income. The ratio of the cars was very less compared to the income. Everything is about ratios. I'll tell you what. I was talking to a guy 15 years ago, and I said, "Oh, I'm showing a house to somebody in Irvine, and there's a place called Woodbridge." And he asked me how much was the house. This was 15 years ago. The house was at that time was worth $500,000. Currently, that house is worth 1.2. But you know what he told me? When I bought a house in 1976 in Woodbridge, he paid $50,000 for it. Mm-hmm. So it's all relative. The house is worth $50,000 in the 70s, 60s, or whatever. I remember the first house I ever sold in 1996 when I started real estate was $180,000. And I thought, oh my God, who can afford a $180,000 house?
Right.
That same house today is selling for $1 million today. So everything is relative.
Yeah. Well, the good thing is, like, for the most part, certain things that you purchase, most things that you purchase lose value over time. A Cadillac would be one of the examples of that, any kind of car. But real estate is one of the few things you can buy that goes up in value over time. And yes, there have been a few years in recorded history where they lost value year over year, but in the long term, they always go up. The trend is always upwards.
Right.
But almost everything else you buy is, except for like maybe gold or other, precious metals, things like that.
Right.
Almost everything else you can buy goes down in value. So that's why I feel like putting your money into real estate is a smart thing. And even if you're going to have any debt at all, I would say the only kind of debt that's okay is debt you're using to leverage to buy an appreciating asset like a home. But I'd rather have a house. Much rather have a house payment than a car payment. Let's put it that way.
Yeah. Hey, Edwin, thanks for your comment. We appreciate it. But I'm trying to guess. Let me guess. You're not a boomer. Probably not. Probably a millennial. But you more than welcome to watch this show. Thanks for the question. We really appreciate it. So I'm going to move on to the next point. We were talking about
POS is probably piece of.
Yeah. Oh, no, don't go there. Don't go.
Well,
there.
it probably is.
Okay. Yeah.
What he was saying.
Yeah. Okay.
Yes.
So anyway, so I mentioned buy less house, right? What are the other practical tips? Look at the next one, which you already mentioned. I'm so proud of you, Matthew. We are ahead of the game. It says here, make bi-weekly payments to cut years off your loan.
There you go.
There you go. Do you want to explain one more time what it means and how it works with an actual example?
Yeah, it just means, let's say I work at a job. I get paid every other week. So there's 2 months where I'm going to get 2 paychecks a month, 3 paychecks in a month. And people that work in that schedule know that because they look forward to those months where it's like,
Mhm.
oh, I get an extra paycheck this month.
Yeah.
So if you just pay, instead of just paying a mortgage payment once a month, pay half a mortgage payment every time you get a paycheck, right? That's essentially it. By doing that, you'll essentially be making 13 mortgage payments a year. Your
Mhm.
30-year loan will be paid off in a little over 22 years just by doing
Right.
that.
So I'm going to give an actual example because I did a video and had a lot of questions on it. They were confused. So the way it works is if you have a 3,000 a month payment, as an example, and you're paying, let's say on the 15th of the month, what Matthew is saying is bi-weekly payment. What you do is take the $3,000, split it in two. So pay on the first, as an example, 1,500 on the first, and then pay the rest of the 1,500 on the 15th, which is still $3,000. You're not paying more. You're just paying half twice. By doing that, you end up paying 13 mortgage payments instead of 12. And mathematically, I did this math. You'll save about $70,000 in interest, 70,000 in interest, and you save about
You
6 years.
know, I'm not actually sure if they're only making, if they're still only making 2 payments a month. I'm not sure that is true.
Yeah,
I
it
think
comes up to 13 payments.
because
It does.
I'll have to run the numbers on that. But what I was referring to is 2 months a year where you make an extra half payment, basically.
Right. So what it ends up is you end up paying, of course, depends when you start, when you pay. On average, you end up paying one more payment per year. That's what it boils down to. And there was a calculator. You can go on it and check it out. Let me see if I can find it. Biweekly calculator.
Because if what you're saying is true, and you don't have to pay any more, and you're just paying 2 payments that add up to the same as the whole,
Mm-hmm.
I don't know that that's true.
Yeah.
But if it is, I'm going to start doing that tomorrow because I didn't realize. But I'll have to ask.
Yeah. You
That's a
don't
good
pay
thing.
more. Yeah. You don't pay more on your paycheck, but you end up paying more. So you don't really feel the pain of it. Like you said, you get 2 paychecks a year more or whatever.
But I think somehow you still have to part with more money in the course of the year in order to
Right.
make it pay off quicker.
Right.
There's no way around that.
Right. Okay.
So
Yeah, I don't know if you let me, well, I was trying to share it, but I won't share it. But yeah, it does work. I did a video on this. You can go on my channel, Home Savvy Central. There's a video that I says, 9 ways to pay off your mortgage earlier. 9 ways. One is bi-weekly. One is paying extra on lump sum. One is refinancing, right? One is recasting your loan. One is refinancing your loan. And the other one is, there's nine ways to do it. So it does work. Paying earlier, sooner, it boils down to mathematics, right? Interest is about math. The longer you take to pay, the more interest you're going to pay. The higher the mortgage payment, the higher your payments, right? The higher your term of the loan, the lower the payment. So it's mathematically this works. And mathematically, the house you buy on a 50-year mortgage is going to cost you way more than a 30-year mortgage. That's the point I want to drive across.
Yeah, and it's the same thing in the other direction when you're saving money. That's why little bit of savings goes a long way because of compounded interest. You earn interest on the interest, and your money grows. And over the long term, a small amount, a small contribution to your 401k or whatever can amount to substantial money in the long term because of that compounding interest. And when you have a mortgage, it's the opposite. You're paying compounded interest. And the faster you pay it off, the less compounding happens.
Right, exactly. And the other point they say, we were talking about it, how to practical tips for buyers. It says here, look for assumable mortgages, take over a seller's lower mortgage. And I know a lot of FHA loans are assumable.
All FHA and VA loans are assumable. The challenge is because of the value increases that we've had of late, almost all of the loans that are out there the loan balance is substantially lower than what the house is worth. So It might be, an $800,000 house, and they only have a $400,000 loan at a very low interest rate because they bought the house for $400,000 3 years ago, right? So their loan was 400. So if you want to buy that, yes, you can take over the $400,000 loan at the low rate. But now, if the house is worth 800, now you've got to either pay that extra 400,000 in cash or borrow it. But when you borrow that, then it's a second loan, and you're looking at, the rates on a second lien being 8, 9, maybe even 10% interest rate, which offsets some of the benefit of having the lower rate on the first 400,000. So that's the downside. There are a lot of companies that tout this, assumable loan thing and send people out with the dream of looking for a house where they can do that. But that's the flaw in that is.
Well, here's the flip side, and I totally understand. Remember, I mentioned earlier, there are up to 2 million loans, FHA loans and VA loans, up to 2 million in default. And they said that 60% of those loans were homes that were bought in 22, 23, 24. So let's take some states as an example. I'm just throwing a number. Let's take Florida, Texas, Tennessee, Utah, some of the states where prices have gone down. Let's say in 2023, somebody bought a house for $400,000 on an FHA loan, 3.5% down, whatever. And it was in Florida, in a disaster area. Home prices have come down, right? You can easily take over that loan. Or in Arizona, where home prices have gone down. Texas, home prices have gone down. And these people are behind on payments. If I go to somebody who's behind on payments, hey, Mike, you bought your house for 400, you owe 380, your house value is 380, I'll take over your loan. What's wrong with that?
That would be great. In my market, there's no houses that went down enough.
But there's a lot of markets that all of Sunbelt, most of Sunbelt.
Well, I mean, I think Atlanta's kind of, isn't that considered
Louisiana, Texas, Arizona, all those Sunbelts, prices have on average gone down.
But not that much. They haven't completely reversed the gains.
3 to 5 to 10%. And a lot of people who bought, and I'm talking people who bought 2 or 3 years ago. I'm not talking about the guy who bought 10 years ago where he bought for 400. That house is worth $700,000 or $800,000. Talking about those people in the last 2 or 3 years.
Yeah, I mean, honestly, I don't know those markets and what's going on there, but it in my market, it doesn't work.
Right. It doesn't. Yeah, in California, it doesn't work. At
least now. I mean, if prices fall, then it becomes an option.
Right. Okay. Now I'm going to throw 2 sentences. I want you to explain it. Just what your thoughts, explain the sense, okay? And this is a big takeaway. It says here that as a realtor, debt should build wealth, not bury it. What does it mean to you when I read that?
That goes back to what I said before. The only kind of good debt is debt on an appreciating asset. So if you're borrowing money to buy something that's going to go up in value, it's good debt. And there are people who would disagree with that. There's people out there touting zero debt, and that's the lifestyle, whatever.
Right.
But the way I look at it is, for responsible people that understand finance, having debt on a house is not necessarily a bad thing. And even buying rental properties and having debt on multiple appreciating assets is a good thing. Because then it's not, I don't consider it debt. I consider it leverage. It's a big difference.
Big difference. Right. Okay. The second takeaway, if you're a lender, it says, if it sounds too good to be true, it probably is.
That's just, that would go, the 50-year mortgage is one of those things. Sounds too good to be true. And we already discussed to oblivion why it is too good to be true. And there's a lot of things like that too. Some of another one that falls into that category for me is those down payment assistance programs. A lot of some of them are grants, which is okay, except you pay a much higher interest rate to get the grant. but a lot of them are second loans that have to be repaid. And the danger of those that people don't realize is, let's say I buy a house, 400,000, I have to put no money down because I've got a grant. But what it really is a first loan of 97% and then a grant for the other 3% that has to be repaid. The danger of that is now you're doing that at, let's say, 6.75% interest rate. Let's say rates do go down. Let's say we get those 5.5% rates and you want to refinance. Well, guess what? You can't refinance that full amount that you owe. You can only refinance with the down payment that you never paid. So you end up stuck in a loan at a higher interest rate for a much longer period of time.
Right.
So that's a too good to be true. It probably is. That's an example.
Exactly. Makes sense. Yeah. Yeah. Again, if you're watching this, if you have any questions about any loan things or lenders, Matthew is a lender. His information is on the description. It's also on my channel in this video description. His contact information is there. If you have questions, what's happening in your area about this loan, hit me up. I can refer you to a realtor in your neighborhood just to talk to them to get some advice. So I want to throw that out. So feel free to do so. So let's recap. Two things I want to recap. Number one is 50-year loans sound like relief, but actually delay financial freedom, right? Because you tied to it for 50 years. You know, it's like a chain on your legs or hands or body. You tied to it unless you refinance. But my take is, if you're struggling to buy a 30-year mortgage today, and 6.2 is not a bad loan. If it's 8%, 10%, that's a bad loan. 6.2 is, I say, a good loan. If you look at the average last 35 years, it was 18%, 12%, 8%, 2%. The average is 7.2. So if you look at the average, 6.2 is a darn good loan. And if you're struggling to get a 30-year loan and now you're thinking about 50-year loan, you got a problem, mathematically speaking. That's my opinion. The best affordability fix is smart buying, not longer debt. What does that mean? I mean,
I don't know what you mean by smart buying. I mean, maybe just.
Well, it says here the best affordability fix is smarter buying, not longer debt. Probably what they made is, instead of buying a 500 home, get a 320, a 425 home.
Yeah, but that doesn't work when, if you're somebody who your max is below what you can get anything for, which is a lot of people. So a lot of first-time buyers just can't. If they buy what they can truly afford, they're just not buying. I mean, there's nothing out there.
That's true. So then just rent, right? I mean, what? In fact, the new American dream, and this is a statement making from studies. You mentioned earlier that it's very expensive to buy homes. It's, in this market, today's market, in the top 70 metro areas, or it might be 100, and I have a chart, I can pull it out. It's cheaper to rent in those 100 metro areas than buying. If you do the math, if you do the utilities.
Well, it is on a short-term basis, but like I talked about.
But we're talking currently, we're talking right now. Of course, anything can happen next year, right? I mean, rates could be 2% and, everything changes. But as of right now, in this current market, in the top 100 or 70 to 100 metro areas, it's cheaper to rent than to buy. And the article said that the new American dream is not to buy a home anymore. It's twofold dream. Number one is to pay off debt. And number two, be able to rent. That's the new dream.
Yeah. I don't know that I agree with that, because the long-term benefits of owning versus renting, that's just perpetuating the generational wealth gap further. I do think people should strive to buy a home. It's not always, you don't always have to do it, in your 20s and rush it. And you need to get your career on track, get your income up to a level. You work hard, find a career that makes money, find other ways to make additional money, by doing small businesses and things like that, become financially literate, like you talked about, understand how all this works, understand how small amounts of savings become a lot and everything. And, put yourself in a position where within the next 10 years, you're going to be in a comfortable position to buy a home.
Right. Yeah.
Maybe don't put the cart before the horse, but I think the American dream should still be buying a home, because everybody ends up better off in the long run by owning.
Right. Absolutely. Buying a home is the dream. It should be the dream. It may take longer, but after 30, 40, 50 years, when you bought a house now and paid off in 30 years or 50 years with a 50-year loan, you won't have a mortgage payment then, but your rent, what you're paying right now at $3,000, will be $9,000 or $10,000 a month.
Yeah, and like AK said, it's kind of a form of rent control by buying.
Exactly. Right.
Because your payment stays fixed for that whole duration.
Right. And a peace of mind. You don't have any debt. You don't have to refinance, and you don't have to, you can sell the house and move somewhere in a smaller area.
Yeah. Now, I would argue if you live in a city like New York where they actually have rent control, it becomes, there, I may say never buy, unless prices come down. But, if the city doesn't have any rent control measures, the only way you're going to get rent control is by buying.
Right. Yep. So, a lot of cities are getting rent control, especially metro areas. Well, I think we hit the end. Matthew, thank you so much for sharing. You had some great ideas. That's why I invited you, because you're a lender and a realtor. You have a lot of insights and information on it. If you need some help in the Atlanta area, please reach out to Matthew. His information is on my YouTube channel in the description. Look it up. And if you're looking to buy or sell or want to talk to a realtor anywhere in USA, I belong to the top agents network throughout USA, so I can refer you to one with absolutely no obligation. We'll be back next Tuesday.
Unless it's in Atlanta, then you can call
Atlanta. You got Matthew there, and his information is there. What's your website? Did you put your website?
I put it in there, but I will do it again in case.
I'll put it in again so they know. I know it's
realestateforatlanta.com.
Okay.
And it's going in the chat. So that's my website. If anybody wants to reach me.
Yep. All right. That should do it. Thank you again, Matthew. We'll see you next Tuesday at 5 o'clock.
All right.
Take California care. Time. Thank you so much.